Good day to all of you, and it gives me great pleasure to welcome you to today's webinar organised by ICMA and Frontclear. This is one of a series of Africa-focused webinars we're organising jointly, and today we'll be discussing specifically how to accelerate Nigeria's repo development. Firstly, I'd like to thank Frontclear, not merely for the collaboration in preparing for today's webinar, but also for the ongoing and first-class cooperation over many years as we contribute to the capacity building agenda in many different countries around the world. This includes 6 countries on the African continent. We enjoy the interaction with Frontclear, and the combination of ICMA's and Frontclear's expertise has been, in my opinion, highly successful. This work is wholly in line with ICMA's mission to promote effective, efficient, and inclusive capital markets. Our own footprint in Africa is growing, and out of our total membership of 600 institutions, there are now 16 member firms based in 5 African countries. This includes 2 members from Nigeria, FMDQ, who are with us today on the panel, and the Africa Finance Corporation. The membership of these important institutions demonstrates a desire to drive forward developments in their capital markets in line with international best practice standards. Nigeria is a good example of how the combination of Frontclear's and ICMA's expertise can support the development of a functioning repo market. And as we all know, this is such an important foundation for further capital market growth. It's really good to see that there's been significant recent progress with the adoption of closeout netting in default scenarios as encapsulated in the Companies and Allied Matters Act 2020. But challenges still remain in the construction of a fully functioning and openly accessible repo market, which can support both cross-border and domestic transactions, as we'd all like to see. Challenges both from a market structure and from a regulatory perspective. We'll hear much more about this on the panel which follows, and I'd like to emphasize that Frontclear and ICMA remain committed to helping this development. Now I'd like to introduce Lisa Cleary, the moderator of today's panel. Lisa is a senior director in ICMA's legal department and an expert in the repo market. She handles all our GMRA and related work. Let me thank her and all the panelists in advance for their contribution today, and I hope that all of you listening to this webinar find it interesting and useful. Over to you, Lisa.
Thank you very much, Martin, and welcome everybody to today's event. I'm really pleased to be moderating this panel discussion on the development of Nigeria's repo market, and I'm very pleased to introduce you to our panelists. I'll ask each of them to introduce themselves, giving us an indication of where they work and also how they're involved in terms of the development of the market. So, Jumoke, can I ask you first?
Good afternoon, everyone. Thank you, Lisa. My name is Jumoke Olaniyan. I'm the Vice President, Market Architecture at FMDQ Securities Exchange Limited. I handle product and market development and regulation in the Nigerian financial market under FMDQ.
Onyinye, can I ask you to do the same, please?
Hi, my name is Onyinye Okafo. I am a partner in the law firm of Udo Udoma Bello Sage. And as a partner and as a lawyer, we advise on structured finance products and engage in such transactions as well. I'm happy to be here.
Thank you very much. Sumbo, welcome. Could I ask you to introduce yourself, please?
Hello, everyone. My name is Sumbo Olatunji, and I'm the Group Treasurer for Access Bank. My role here is as a market player, and all these things directly affect me. Thank you.
Thank you very much. And finally, Hugh, please.
Hugh Friel from Frontclear. I head up the structuring efforts in sub-Saharan Africa, and indeed Nigeria is a very important geographic scope for me. So delighted to be joining the panel and very much looking forward to the discussion.
So we're going to treat this panel discussion in two parts. And in the first part, we want to introduce the concepts to you, make sure that everyone's up to speed in terms of where the market sits today and recent developments. And then in the second part of the discussion, we're going to concentrate on more future-looking topics. So what needs to be done next? What's next in terms of reform? And what's the outlook in terms of the market profile and opportunity? So first of all, let's get everyone on the same page. Let's bring everyone up to speed in terms of what's happening today in the Nigerian repo market. So I'm going to come to Jumoke first, if that's okay, and ask you to please set the scene. How long has the development of the repo market been underway, and how has FMDQ supported this work?
I think that we can trace the history of the repo markets in Nigeria way back to the 80s, if you would, where the central bank, of course, deploys repo transactions as one of its open market operations tools in the Nigerian financial industry with its banks. But I gather we're not focusing on the repo market as it relates to the market practitioners and the central bank, but interbank repo market. And giving off from when the central bank, had that structure put in place, the market players themselves have progressed to transacting and engaging in funding transactions between themselves, what we call an interbank market, using what is popularly known in the Nigerian market, and it's a Nigerian innovation, as open buybacks. It's a modification of your sell buyback type of transactions, but in Nigeria, it's open because it necessarily doesn't have an end date. You typically would just keep rolling it over for however long you want to roll it over until you actually need the cash or the securities back, and then you would close it. So it's a very popular tool of repo market in Nigeria. Open buybacks are largely overnight transactions in Nigeria, and they probably account for anywhere, would say 80 to 90% of the repo market in Nigeria. And then you will have other tenant type repos in the Nigerian market. So that's like history in a very tight capsule that you would say. But what has happened is our market is such that our open buyback transactions and the repo transactions are largely off your government type securities and the central bank type securities. So you find them collateralized with Nigerian treasury bills, open market operations securities, and most recently central bank securities, special bills. Historically in the market too as well, the central bank did have a version of a master agreement that it had deployed for its transaction with the banks, and the banks themselves had gone ahead to adopt that master agreement. We call it the Nigerian Master Repurchase Agreement for transactions between themselves as well, because it's largely still a bilateral market. The repo market in Nigeria, and this covers what you have, as I've said, the OBB transactions and the tenant repos, are settled off the infrastructure, historically off the infrastructure that is managed by the central bank. The securities depository for government securities and central bank securities sits with the central bank, the scriptless security settlement system, which we call S4. And your cash settlement would settle off the gross settlement system, which is typical of funding settlements in general in any market or economy. And so largely, while the central bank provided governance over its transactions with banks, the banks themselves had coordinated themselves in an association of bank treasurers, now known as the Financial Market Dealers Association, and sort of gave guidance to the governance in that market space historically. And that's how that market had been trading for a couple of years, I'd say over 20 years, if now. A bilateral market, largely open buyback type transactions, but with some tenant transactions in there, largely off the back of government securities and central bank securities. In more recent times, there've been quite a bit of evolution, and I'll say a lot of this has happened probably in the last, let me term it, between the last 4 to 5 years. There's been quite a little bit of evolution in that market space for the better, and I'm sure anyone here will tell you they're most excited about that. Let me start with the legal and regulatory framework. Hitherto, and I know my co-panelists will speak a little bit more to that, hitherto we didn't have as much clarity on the bankruptcy remoteness of the collaterals that were pledged for our repo transactions. But up until the upper year, or last year, I'm sorry, we have a new piece of legislation that came out that has introduced closeout letting and largely bankruptcy remoteness to all types of financial market transactions in Nigeria, including the repo transactions, and therefore giving a lot more credence to the collaterals that have been pledged for repo transactions, giving counterparties to that transaction a lot more comfort. I'm sure we'll speak a little bit more to that. Concurrently, we find that ourselves, FMDQ, having come into play with a mandate where our job is market development and regulation development for the market space. We've worked closely with the banks, who are main constituents, to develop a more inclusive and more robust repo market. And what we've done is introduce infrastructure, market infrastructure, to improve the way the repo market has can be traded. What we've done is we've introduced the market framework, or we've upgraded the market framework to make it a centralized market trading venue, so on-system trading, and supported that with centralized collateral management and straight-through processing for settlement into the central bank S4 and RTGS systems. So as you can imagine, that's bringing a lot of efficiency into the way the whole market structure is going to be operating. And to support that, of course, part of what the exchange has done as well is improve the governance in that area by having a repo market framework where we all define what are the type of repo transactions that we're going to be engaging in this market space. And what we've done is we've adopted both the classic repo and the sell buyback repo. Counterparties can pick whichever of these security types of repos best suited for their need. And we've continued to, declare the types of collaterals that would support this. Intermediate, we're continuing with the government securities and the central bank type securities. These are the most liquid currently in our market space. And as we have more other types of debt securities coming to the market space, or even the liquidity in those securities improve, they'll continue to be introduced into the repo market framework and structure. So in a very quick nutshell, that has been very brief history of our repo markets and where we've taken it today. And the role FMDQ has played is now to become like a central project manager where we're bringing all the stakeholders together, where the project office that's ensuring the push for all the deliverables, the systems, the regulation, the agreements, and basically making sure there's a consensus on an agreement on how the market framework would go. And taking off from there after the exchange with our sister companies, the FMDQ Clear Limited and the FMDQ Depository, are supporting the trading, collateral management, risk management, and settlement of repo transactions in the Nigerian financial market.
Thank you, Jumoke. That's a really helpful overview of, a small bit of history and where we are today. And clearly pulling all of these strands together is what's going to push this market forward. So you touched a little bit there on the legal and regulatory reform. I'm now going to pass over to Onyinye.
Thank you, Lisa. So as we know, repos are central to provision of liquidity, and the Nigerian repo market remains dominated by the money and interbank markets as the main liquidity providers. And just as Jumoke said, it is basically a bilateral market. Now, in terms of regulatory development, although not much has happened recently due to the challenges of the past year occasioned by the COVID-19 pandemic, I expect that with the legislative reforms, which I'll be discussing shortly, that steady growth will be experienced in the repo market. So some of the recent developments include the issuance by the Securities and Exchange Commission of rules on central counterparty. That was in December 2019, which has paved way for the registration by the Securities and Exchange Commission of FMDQ Clear Limited and the NG Clearing Limited, which is a central counterparty that has been promoted by the Nigerian Stock Exchange, so as central counterparties. I understand that for both companies, the Nigeria SEC has issued them with an approval in principle, and that it is just a matter of time before the final license would be issued. In relation to pension funds, however, nothing much has changed. And even though the amended investment regulations issued by the National Pension Commission in 2018 define securities broadly to include derivatives, the pension funds administrators are not yet allowed to invest pension funds in financial products such as repos. I understand that for now, the focus of the National Pension Commission is on investments in foreign denominated instruments. I expect, however, that with the recently passed Companies on Allied Matters Act 2020, that act would pave the path for an active engagement by the pension funds administrators in the market. In relation to legislative reforms, in 2020, precisely August 7, the President signed the CAMA 2020 into law, which incorporates the netting law. The netting provisions of CAMA 2020 are based on the 2006 ISDA model netting law. Prior to the enactment of CAMA and in the past, I am aware that one or two interest groups, I believe that the Nigerian SEC was one of them, in the past have tried to promote the enactment of a standalone netting law, but this was not possible. Therefore, when one of my partners was appointed the chairperson of the committee that reviewed the Company and Allied Matters Act 1990, we felt that would be a good opportunity to incorporate netting law or provisions in the amendment bill. At the time, I and my team and the FMDQ worked closely on the bill. Although we faced some few challenges, including some amendments, deletions made to the initial draft of the provisions that we presented for adoption, I am happy to confirm that the netting provisions have been incorporated as Chapter 28 of the Companies and Allied Matters Act 2020. And based on that chapter, and specifically sections 718 to 721, netting arrangements are enforceable, including against an insolvent counterparty. And those sorts of arrangements cannot be limited by any rules related to insolvency or similar proceedings. Under Section 718 of CAMA 2020, which is the definition section, qualified financial contract is defined to include repos, reverse repos, and buy or sell back agreements. Now, in addition to the Companies and Allied Matters Act 2020, the Bank and Other Financial Institutions Act 2020, and this act repealed the 1991 equivalent, was enacted last year. And just like the Companies and Allied Matters Act, accord special protection to netting arrangements and or collateral arrangements entered into by banks and other financial institutions regulated by the Central Bank of Nigeria. And this would be where the license of the financial institution is revoked, or the financial institution is being wound up by an order of the court, or a liquidator is appointed. And in these scenarios, the liquidator appointed is bound by existing netting arrangements entered by the bank or other financial institution prior to the occurrence of the insolvency or revocation of license, whichever is applicable. Collateral arrangements entered into by financial institutions with third parties are also protected. I should mention that we were not involved in the review of the BOFIA bill at the time. Finally, I won't forget to mention that last month, the Central Bank of Nigeria issued the Repo guidelines, which amended the guidelines that were previously issued by the Central Bank in 2012. This affects banks and financial institutions that have entered into the Nigerian Master Repurchase Agreement, which Jumoke alluded to earlier. So these are some of the recent reforms and developments which I expect and strongly believe would lead to more developments in the repo market within the coming years. Thank you.
Thank you very much. And so I guess now we've got a sense of the market structure, we've got a sense of the recent legal reforms. So it would be really good to get an insight into the market profile. So I'm going to ask Sumbo to please provide us with a picture of that market profile today of funding. So Sumbo, could I ask you to speak to the market profile today in terms of a local currency and foreign currency perspective?
Okay, thanks, Lisa. So typically in the market, as you've asked, there are various sources of funding for banks. The main source is deposits from customers. We also have funds from the PFAs, which are the pension fund administrators and asset managers. However, to mitigate short-term squeezes, like Jumoke had alluded to, we have the open buyback, which is a form of an open-ended securitized borrowing and lending takings from banks, which happens, and this happens every time. That's on the local currency side. We also have repos, which are done either for short-term or relatively long-term funding. And you also do repos when you want to take positions in the fixed income market, where where if you want to go short or something. And basically, the main problem we have with that, as Onyinye had pointed out, is the fact that PFAs, who hold a lot of these securities, are not allowed to do repos and repurchase transactions, which also hampers the fluidity and the liquidity in the market. I'll also go to the other side, which is where you have foreign currency borrowings. Like I said, most of our deposits come from customers and structured funding, but there are times when you need to, bridge short-term funding gaps, which is where you go into the repo market, which is where Hugh comes in. However, we've seen that market slow down because of the recent directive by the central bank that you cannot issue CCIs unless there's evidence of conversion of the foreign currency. So what that has done is that has slowed down the market, because a lot of market participants, international counterparties who would have loved to play in this market, are not comfortable with the fact that they don't have the security, which is that of a CCI, so that in the event of a default, they can actually go to the I&E market and buy their funds. So those are basically the two repo funding sources we have in the market. Thank you.
That CCI point is certainly one that we will come back to in the next section of the discussion. But for now, Hugh, perhaps you can indicate how Frontclear have been involved so far in terms of developing the repo activity in Nigeria.
Indeed, I think the Nigerian market, it's somewhere that Frontclear engaged with very early. I think probably the second trade ever done by Frontclear was in Nigeria back in 2016. And it has been a constant feature in our guarantee portfolio since then. And there's sort of a number of, let's say, elements to that that I wanted to just touch upon. Of course, one is the legal certainty. I know I'm repeating what has already been said, but I can say from the perspective of the cross-border transactions and taking typically dollar funding in Nigeria into the market in the form of repo, this legal certainty is something that is really an important element, and the enforceability and the improvements that have come with CAMA have been key to that. So to re-emphasize that point, I think the second element that Nigeria represents very well is on the infrastructure side, and again with FMDQ. And when I hear Jumoke saying that they're project managing elements of developing infrastructure, that gives me a lot of comfort, because I think FMDQ are an extremely unique organization, and I think they're unique in their sophistication, but also in their ambition and what they want to do. So again, Nigeria is an outlier in that regard. It is somewhere where there's good infrastructure in place. And then a third important element that sort of really, if I look to the supply and the demand of cross-border trades that we look at, you really have quite a sophisticated financial market in Nigeria. So, all of the banks, long before Frontclear ever existed, were engaged in repo and swap activities. Their systems, the staff are typically sophisticated. And that really creates an environment where a guarantor like Frontclear can come into a market and start to really latch on to existing relationships. It's not the case in Nigeria that we're coming in and doing groundbreaking transactions, perhaps, which is the case in other markets. In Nigeria, it was very much an already functioning market, and we are adding some capacity in that regard. And, I think probably 70% of what Frontclear does in general is repo type products. And that's probably a nice reflection also of our Nigerian business. The repo product is something that is in demand, and we've been particularly useful, I think, in providing some comfort around accepting local currency collateral in the repo transactions, and being able to overcome some restrictions that perhaps cross-border funding banks were facing. I think there is some challenges, of course, that remain, and maybe we'll touch on that probably more in the second question. But indeed, I would echo what Sunbo says in relation to the certificate of capital importation. This is a key element, and indeed, I think a lot of time and effort is currently being put towards sort of getting clarification and working around via structuring, etc., on this issue. But it should be highlighted, I think, as one of the key issues on the cross-border side also. And then I think the other element that I maybe speaking to some of the questions that we're seeing coming through, a very important aspect is that on the repos that we're doing in Nigeria, it's very clear that it's on the basis of full legal title transfer. So in a workout scenario, of course, that provides a lot of comfort in the ability to liquidate your position, and the speed and certainty in that regard is very important. So you don't have to effectuate a pledge or anything like this. It's done under full legal title transfer, which of course is a key feature of true repo. So, I think in conclusion, it's somewhere that's going to continue to keep us very busy, Nigeria. We're dealing with daily requests and queries. There's always a strong pipeline. It is a market that, there will always be demand for dollars cross-border. So there's a sort of a structural demand there. And a little bit the trick for Frontclear is to see how we can balance the supply and demand dynamics to actually get transactions done by providing a guarantee where needed.
Thank you very much, Hugh. So I guess that's brought us all up to speed on various different factors which create a scenario for these markets to flourish. And it's been clear throughout this Frontclear webinar series with various different jurisdictions that cross-agency collaboration is absolutely essential in order to get these reforms through. So in this next section, we're going to speak to that a little more. We're going to talk about what the future reforms are. We've got this fantastic foundation in terms of the ICMA legislation, but what's next? What's out there in the future in terms of further reforms? Is it regulatory? Is it market structure? So I'll come to Jumoke first. So looking forward, are there any regulatory reforms which could further foster the development of the cross-border repo market in particular? And here I'm thinking about the adoption of industry standard documentation. You've mentioned the Nigerian Master Repurchase Agreement, but looking more to industry standard documentation, the GMRA, for example. And also, if you are willing to touch a little bit on the provision of CCI's point as well.
Yes. So the passing of ICMA, I think, is a turn point for the Nigerian financial market, because the enforceability of a lot of the financial market transactions and that certainty around it gives room for a lot of innovation, a lot of development, gives room for the risk management in any financial market. And that is what we're just seeing happening in the Nigerian financial market now, off the back of that ICMA legislation and the netting clauses that it contains. A lot more can be done with regards to regulation, with regards to documentation, with regards to risk protection in the market. One of such is, as I mentioned, we hitherto have had modified version of a master agreement, which is the Nigerian Master Repurchase Agreement. Now that, of course, Nigeria is looking to open up, and as Sunbo had mentioned, we want to attract back the cross-border funding type of transactions. And even for our local and domestic funding, we want it off the back of international best practice yes, the market is looking to now generally adopt the GMRA, the Global Master Repurchase Agreement, because now we have the legislation by which we can enforce all the contents and clauses of the Global Master Repurchase Agreement. I think that would greatly help expand the scope and the participation in the Nigerian repo market. I think off the back of that is it gives us credence as a market, the FMDQ, the daily member banks, and any other interested party to push for advocacy to other players who we've not seen take pride of position in the repo market. Sumbo mentioned how the pension funds, and when you mentioned how the pension funds are not very active in a repo market because of some of the investment guidelines that they have to contend with. Now, with the back of these legislation, the common law adoption of the Global Master Repurchase Agreement, we are able to speak to the regulators to explain how their concerns on the risk around the assets of the pension funds can be protected, from a legal perspective. And we believe this would lend credence to them joining the repo market, and of course, expanding the volume of that repo market. I'm just going to, extend that to your question a little bit. And sorry, before I go further, I think that even goes beyond just the pension funds. We have the insurance companies whose regulator has just recently asked them to recapitalize. And I mean, if you look at that, if they're going to recapitalize a lot more capital, those capital needs to be used efficiently. So, of course, they're going to need more outlets, one of which can be the repo market, because they just might be another source of, funds that and securities that can come back into that market. To extend your question a little bit, I think infrastructure, financial market infrastructure, is also going to be a critical evolution of our market that is going to support the next phase. With the introduction of the central counterparties, the FMDQ CLEF, for example, we're able to bring CCP and innovation to this market space. And that is further risk management in the market space, again, which I think anyone in the capital market, will always want to be sure about and protect, be sure their transactions and their assets are protected. So generally, I think with the evolution of the regulation, which we've seen, success in the advocacies that we need to go out there and enforce, and the infrastructures, we're creating a case where investors, institutional or otherwise, in this market case, can maximize their risk return mix, because they're able to use what would hitherto have been idle assets or idle cash and gain further, returns on them by bringing them into the repo market space, picking up additional yields, all on a high degree of safety. So I do think it's exciting times in this market space going forward.
That's very good to hear, and I'm sure shared by many of the participants on the call. Now, I think you've touched on it in what you've just mentioned in terms of this foundation of the legal reform. I just wanted to deal with this point around what, now we've got this legal foundation. Are there other things that need to be addressed to encourage repo market activity? And Sunbo's mentioned it, Hugh's mentioned it. How does the provision of CCIs change the risk profile?
So one legal consideration that comes to my mind relates to the risk of recharacterization of repo as secured lending or collateralized loan. Unlike in the English courts, where I understand that this issue has been addressed by their courts, as far as I am aware, this issue has not been decided by our courts, and so it is uncertain how it will be determined. Having said this, I believe based on a review of the general law and market practice as exists, it is unlikely that the Nigerian court will characterize repos as unsecured as secured loan. Also, I should mention that typically in the absence of legislation or case laws, the Nigerian courts will look to the English authorities for guidance as the decision of that court are persuasive on the Nigerian courts. Another consideration which I think Jumoke had alluded to when she was speaking would be standardization of documentation in relation to repo transactions. Currently, as you would expect, because the market is largely a bilateral market, as we would expect, each bank in Nigeria do enter into this transaction using their own documentation. And of course, we do see the GMRA often, but not all banks currently execute that. Some of the banks execute what we call the Nigerian Foreign Exchange Master Agreement. And so it would be good to see the market move to standardization of documentation. I think this would encourage the repo market activity. Now, in relation to CCIs, which is really an acronym for Certificate of Capital Imputation, CCIs provide evidence that funds have been imported into Nigeria for investments in equities or debt through an authorized dealer and have been converted into Naira. Now, authorized dealers are banks licensed by the central bank to deal in foreign exchange and would be the ones to issue the CCIs to the relevant investor. Currently, I think all the commercial banks are authorized dealers. Now, CCIs will not be issued where the funds are inflowed into Nigeria for investments but are not converted into Naira, which is typically the case in relation to repo transaction, because the Nigerian counterparty has forex needs and will not want to convert to Naira. And if this is the case, the transaction will not be entitled to a certificate of capital imputation. In an ideal world, this should not be a challenge. However, the difficulty typically arises if the Nigerian counterparty defaults and the investor sells the securities. Of course, the sale, selling the security, getting Naira, no CCI to be able to access the official foreign exchange market to purchase USD and repatriate the proceeds of sale. Understandably, this would be a challenge for an investor who would try to mitigate this sort of risk. Now, early last year, I heard of what I would term a contingent CCI, which I understand as CCIs issued in transactions which create a contingent foreign exchange risk, such as repos and derivative type transactions. In simple terms, the CCI is issued without conversion to Naira and can only be utilized when the contingency crystallizes. Now, I came across this type of CCI in an FMDQ bulletin earlier last year. But the bulletin actually provided that such CCIs would only qualify as an eligible underlying transaction for hedging and OTC foreign exchange futures when a contingency crystallizes. That would be a repayment default in such transactions. What this really means is that such CCI do not qualify as eligible underlying transaction prior to this crystallization. And of course, once it crystallizes, subject to validation or determination by the FMDQ, it becomes eligible for hedging OTC. Although there is no CBN, Central Bank of Nigeria guideline on this CCI, which suggests therefore that such a CCI can be issued. I understand that this is relevant only in relation to purchase of OTC foreign exchange futures, and it is still unclear to what extent such CCI can be utilized in the foreign exchange market. Although I do understand that it is some banks utilize it, but time will tell how we proceed.
Clearly a topic that merits some further discussion. But perhaps I can move on to Simba and ask, what's the outlook in terms of the potential liquidity supply if these reforms are able to be realized? Jumoke has already indicated that there's great potential here, and these are exciting changes that are being made. But what do you see as the outlook in terms of the market profile?
So, as Jumoke said, FMDQ released the framework for the purchase agreement, which we think will tackle the current market issues, provide a better risk management structure for the repo market. We also think it will, promote liquidity in the fixed income market. If we can get the PFAs, PENCOM to allow the PFAs to come in, which would also help liquidity and reduce the risk for short help portfolio returns. The structure, the way they've put it and everything should help us. However, we still need some more clarity around pricing, which, they've been a bit silent on because, at the end of the day, it still boils down to some of those things. But we believe that if what FMDQ has put on, if we can get that to work, definitely the market will help to deepen the market, and we'll see a lot more participants and a lot more transparency and price discovery. On the CCI side, I believe it's something the central bank should do. They should look at reissuing these ECCIs, or as Onyinye had spoken about, they should look at giving us contingent Ccis, which will kick in events of default. Because we believe that this happens, it increases the comfort for offshore counterparties, and it will, in event, improve FCY liquidity in the market, help price discovery, and will actually be able to get cheaper pricing. And it would also help the liquidity around the FGN securities, which would see a lot more transparency and flexibility in the market. So it's something I believe if we can get all the reforms in place, we will definitely have a better market.
I'd just like to add to what Sumbo had said. I think from all we've seen, it's the market is obviously going through an evolution of development, of sophistication, risk management. And I think the market is on the path to evolve from being just bilateral to where we can go to tripartite repos. And that, as you know, would be like the most mature stage of the repo market. And ultimately, grow the potential liquidity in that market space exponentially. The legals are there. Once you get the parties in comfortably, you have the market infrastructure that can help the risk management and with innovation. Then bringing in tripartite repos into the market structure significantly helps the extent to which you can use capital, be it securities or cash in that market space, brings in efficiency of the processes in that market space. And I think ultimately always that risk management that everyone is usually concerned about is also further mitigated in the market space. So I think from liquidity perspective, again, if the market continues to grow and develop as it is and evolve and matures into that state of, say, a tripartite repo market, then even the potentials for the liquidity improves even further beyond even what we just have in our market space today.
Thank you very much. So, it sounds like we've got reforms necessary in terms of market structure. We've got documentation reforms that further need to be explored. Cross-market advocacy in terms of participation limitations for particular counterparty types, clarification regarding CCIs and their application to repo. There's much to do, but already much done. So Hugh, how does that set the schedule for Frontclear's future involvement in terms of Nigeria?
Indeed, Lisa, I think all of those elements are going to hopefully keep also Frontclear quite busy. I think on the CCI issue, we even have maybe perhaps an even more unique perspective in that as a guarantor, there is a workout scenario whereby we would have paid out on our guarantee offshore in dollars, and we are in a position where we are holding Naira cash locally with sort of a lack of certainty around how we could potentially convert that into dollars. So that is a sort of a significant concern. I know it's been brought up here, and I think the technicality that there may not be an actual FX conversion, and that complicates the issuance of the CCI, even though contractually there has clearly been dollars being converted for Naira. I think some clarity on that, and it's certainly an issue that is a high priority for us. And then I think the second element of what is going to hopefully keep Frontclear busy will be moving into looking at how we can support the infrastructure, the sort of tri-party repo type structures that Jumoke is speaking to, because I think Nigeria is definitely moving in that direction of central clearing, CCP infrastructure. And with all the benefits that brings, I think it's the right road to go down. And for Frontclear, the challenge is how can we support that type of infrastructure, perhaps with a settlement guarantee fund, and supporting the risk waterfall of the clearinghouse or the CCP with risk capital. So that is certainly something we're engaged with Jumoke and colleagues on, and it's very interesting work for us because it sort of is a different variation of our guarantee, the bread and butter business of guaranteeing transactions between offshore banks and onshore banks will continue. But if we can really move into supporting that infrastructure space, I think that is something that is very interesting, and definitely that is the area that moves the market forward. That really is where we want to see the market move, and Nigeria is definitely moving in that direction. So I think those are the things that are going to keep us busy over the immediate term.
Thank you very much, Hugh. So that brings us to the end of our formal panel discussion, but we're very keen to allow participants to ask some questions, and we do have a couple that have come in while we've been talking. I will just take a look at a couple of the questions now. This is quite an interesting one. Do we have any statistics on market size? Now, I guess market size could be the local market, but I guess probably we're looking at understanding a bit more about the cross-border market size. Does anybody have any indication of stats on that?
At this point, I don't think we have market stats on the size of the market. But if I'm going to guess off the cuff, I'll probably say about 90% of the transactions are done using repos. But you see, this is where FMDQ comes in. Part of what they're trying to ensure is that you can also see, you have a lot of transparency, you know what the market size is, what's going on in that market, which also helps price discovery and also aids a lot of decision making. So as of now, we don't really have any color on the size of the market, but going forward, I'm sure FMDQ will be able to provide that.
I think on the cross-border space, it's typically OTC market, right? So it's although we have good oversight of what Frontclear does, it's probably difficult to get market-wide statistics on that cross-border space. But within my remit of sub-Saharan Africa, it's the most active market, a large market with sophisticated players. So it's just difficult to put an exact figure on the volume of activity.
It's largely still bilateral and OTC, and for the domestic space, which is where we have any form of data at all. We don't have so much insight into the cross-border. It's reported data, not live data on exchange. The banks do report some data. So there's some color, but as you'd imagine, may not be the totality or the exact size of what that market space is. If I might give an indication, and I do apologize, I'm giving you these figures in Naira. It should be in dollars for you to be able to relate. I'll give you total value traded in, say, this is all BP and Repo transactions in 2020. We have about 42.23 trillion Naira traded in 2020 last year. Naira, sorry, I sincerely apologize. This is not dollar figures, but it gives you a sense of where that market volume is from reported data that we have at the exchange. But rightly so, when this comes on system, then you're going to have a lot more of accurate data, be it cross-border or local, domestic transactions on the system.
Mm-hmm. We're talking about the Nigerian market, so I see no problem in speaking about the Nigerian currency. Let's move on to another question. Who are the key players, do you think, using Repo to get liquidity or as an investment? And I guess we touched on this a little bit in talking about the limitations in terms of participation. But who are the key players today? Is it mainly the banks?
Yes, you have mainly the banks. You have also other financial institutions and market players, but the bulk of the transactions are done by the banks.
And when you think about the appetite for that cross-market advocacy that we talked about earlier, is there appetite there for other types of institutions? A couple of the questions here relating specifically to pension funds. Is there appetite there for expansion into the counterparty types?
Yes, I think there's a lot of appetite. The market is shallow as it is. So we have lots of opportunities to further deepen this market. If we can get the PFAs in, the insurance companies, and a lot of other people, we'll see a very deep and active market. So yes, there's a lot of appetite.
I think there's probably a bit of a rising tide element to this as well, Lisa. As a repo market develops and as you get certainty around I mean, the infrastructure and how it works, then I think you're in a much better place to start to include the pension funds, the insurance companies, asset managers in that space. Because the reality is that in most of the markets that we look at in sub-Saharan Africa, there's a large quantity of potential collateral that is tied up in those institutional players. And there needs to be an evolution of the rules and regulations that they must abide by to allow them to play in the repo market. But turning that on its head a little bit, the repo market must also be at a state of development and provide a secure environment for these players to actually participate. So there's a bit of a chicken and egg element to it, but I think indeed Nigeria is well placed to work on this, but getting pension fund, insurance companies and asset managers to play in the repo market would be a key development.
We have a question here. Now, I'm not familiar with the particular guarantee that the participant is asking about, so forgive me if I get this slightly wrong. Has the use of MIGA guarantees been considered for credit risk cover and transfer and convertibility risk cover in cross-border deals? Is anyone familiar with this guarantee type?
Yeah, I can speak to it initially. I mean, MIGA is the World Bank. It's a World Bank guarantee product. My understanding is that it's typically more suited to longer-term infrastructure type funding. So not really money market repo products. And I would say that if somebody's looking for a guarantee in this space, in the repo space, then hopefully Frontclear would be an option to look at, because that's exactly what we do. We absorb counterparty credit risk in repo trades, and indeed we cover that convertibility risk, like I alluded to, and hence why the CCI uncertainty around FX conversion becomes very important for us. So a little bit, a short answer is I think the MIGA product is something that is suited to other elements, and Frontclear guarantee is very much suited to the repo product. But I would say that.
Yeah, we've actually seen a couple of international banks offer this in the market, and apart from risks and everything, what it also helps to is that it lengthens the tenor of the transactions. So typically where repos are done for 180 days to 1 year, we see with MIGA, it helps you lengthen it up to 2 to 3 years, which would also further help to deepen the market. So we've seen a bit of this with quite competitive pricing too. So it's something that Nigerian banks would also be interested in, I believe. Thank you very much.
I just want to thank all of the panelists for their time in preparing for this discussion, for all their hard work in the development work that they're doing in terms of the repo market in Nigeria, and for your time today. We really do appreciate it. Our participants continue to be very interested in developments in the Nigerian repo market, and we will continue to monitor those and support in whichever way ICMA can. So thank you again for all of your contributions. Thank you to the participants for listening, and we hope to see you soon. Thank you very much.